We've got an accelerating inflation rate here. The core rate was particularly troubling. How does that affect the market, the stock market?
Look, it means inflation is far stickier than even the most bearish people thought. So up 0.6% month over month at this point in the cycle is terrifying. Like we should not be here. You want to see that number at a 0.1 or 0.2 because you're going to have a little bit every single month, but the core, so when you strip out food and energy, because those are a little bit more volatile, that is what the Fed is looking at. We are going to get no relief from them. Historically, it takes 3 to 6 months for the rate hikes to take effect. So we haven't seen a lot of what they've done, but I think they'll get more aggressive now, not less aggressive.
And that's bad news for the stock market?
Very.
Down from here?
Yes.
Significantly down from here?
What's next is earnings. And I think you start looking at manufacturing worldwide, global PMIs are contracting, 2/3 of them worldwide. That typically hits earnings pretty hard. So earnings estimates will come down as interest rates are going higher. Not good for stock valuations.
Now, you're particularly keen on looking at the housing market, and so am I. I follow Zillow. And as I was telling our previous guest a few minutes ago, I'm seeing lots of notifications that home sellers are cutting the asking price. That, to me, shows the market, the real estate market, in bad shape. Are you forecasting a collapse in housing prices?
No,
that's a strong word.
Not a collapse, because it's just the structure of the housing market is much different. It's much harder to get a mortgage. There's not as much leverage. However, we could see a 10 to 20 to 30% correction in prices. If you look at the charts for housing starts, construction spending, building permits, new home sales, home listings, all these charts, unfortunately look straight and down to the right. There's some blips ups here and there, but that is not a good omen. So it does not look good for housing. There's a knock-on effect, a multiplier effect to the overall economy. So the economy is rapidly slowing down as the Fed is raising interest rates. Historically, you want the Fed to be raising interest rates into an overheating economy, not one that's rapidly decelerating. So it's bad things on both ends for right now.
Times really changed, don't they? You've been with us on this show for a couple of years. You were king of the bulls at one time, and now you're not.
No, look, I'm always bullish on America, but I think we got another 3 to 6 months of pain in the stock market.
Ouch. Mike Lee, thanks for being here anyway. We appreciate it. We seriously do. All right, folks, now this.